Hello and welcome to this Thursday edition of FreightWaves Now. I'm your host Anthony Smith, and coming up we're going to have Mike Baudendistel giving us a rail intermodal update. But first, we're going to go to the fabulous Donny Gilbert with a carrier update brought to you by PowerFleet. Stay tuned.
Thank you everybody for joining us for today's carrier update, sponsored by PowerFleet. My name's Donny Gilbert. We're going to jump first into dry vans. Yesterday we talked about some reefer markets. Today we're going to discuss what's going on with some of our dry van markets. Starting out with our dry van tender rejection rates. Today here I've got in the red, it's last year, 2019, and the blue here is 2020. So looking here, we're at 5.0%. 95% of contracted freight is being accepted now on average across all the markets in the U.S., which is relatively low, or a high exception rate, but a low tender rejection rate, meaning that right now, on average, our rates are within the range right now of contracted rates. So spot market rates are not elevated, they're not too low, they're just kind of right there hovering in the range of our contracted rates. Last year, we're at 6.92%, so a little bit below last year for dry van freight right now. We'd rather see it around the 7%. 7% is kind of the high end, where spot market rates are right at the top end of contracted rates, and maybe getting above there a little bit. We don't really get excited until we hit about 10%, so we're well below that, but that's where we are currently. It is the February right now, second week of February, so kind of that, slow down period, kind of stuck in the mud right now, but we're getting close to produce season, hopefully starting here soon in the beginning of March. Below here I got our outbound tender lead times. I like looking at both of these because tender rejection rates is the reaction of carriers to the current market conditions, and tender lead times is the reaction by shippers to the current market conditions. So here we see tender lead times, they were about 2.7 up to about 2.52. So they've really been kind of flat here, holding around about the 2.50 mark. So nothing been pushed really far out, nothing been really pulled back in. Normally they'll adjust these if capacity becomes an issue and if rates are jumping up or dropping down. So when we see rates start to increase, we'll see tender rejection rates start to climb. Shippers are seeking capacity a little bit sooner to ensure that they have capacity to cover their load. So right now, we're kind of flat here, kind of matches the flatness that we see in our outbound tender rejection rates. So let's kind of throw this up on a map here to my right. I've got our tender rejection rates for dry vans across the U.S. Now looking at the legend down here, notice from yesterday this legend is quite different. Here we're going from basically 0 to 19.80%, where yesterday went from 0 to almost 56%. So keep that in mind when looking across. A lot of the hot spots are here in the Midwest. These are the areas that we're seeing the highest tender rejection rates, with a few spots up here in the Northeast. And of course, Florida is white as it normally is, and the West Coast out here is also very light shade of blue, because tender rejection rates in these markets are quite low. But looking at this, I want to throw it up here on a big map here, and I want to mix in our volumes. These are dry van volumes only mixed in with dry van tender rejection rates. Starting on the West Coast, you see the shaded areas picking up on our 3D maps. This is because California and some markets up here in Oregon and Washington have higher volumes. Of course, the light shade meaning tender rejection rates are low. So high volumes, but the rates are going to be within your contracted rates right now for these areas. Salt Lake City picked it up here a little bit along with Denver. We know we've had some weather affect these areas, and you see some blue here through the South Dakota, Nebraska, but of course there's really not much shading to these markets because these are very low volume markets, which make them highly volatile. Getting over in here, Kansas City, we got some volumes moving out of, and of course into Ohio and Harrisburg, PA. Moving down here, of course, we got Atlanta and Dallas and Fort Worth, and Houston right here as well. So these are the stronger markets you see that are shaded, but as you see the shaded markets, most of those are lightly colored markets. And because that's where capacity is, from outside markets, they're adjusting and moving their trucks to those markets so they can find loads to keep their drivers moving. So as these markets build up in volumes, of course, they're attracting trucks to move into those markets. Let's kind of throw them up here on the board here to kind of check them out. We have Atlanta, 2.58 for tender rejection rates. 2.58, below 3%. We have spot market rates in the Atlanta market probably dropping down below contracted rates, meaning if you're a shipper, they might be stopping the contracts and might be shifting over to the spot market. So keep an eye on the spot market if you're in the Atlanta market and not receiving your contracted loads. That's because rates have dropped below those. Memphis, 4.8% contracted rates. Harrisburg, PA, 6.06%. Again, that's putting our spot market within contracted rates as well. LAX 3.02 and Dallas at 2.8. So Dallas is also a market with a lot of volumes, but the rates are very soft in the Dallas area. So if you need to keep your drivers moving, these are markets that have a lot of volumes and they're not too terrible when it comes to the rates. Like I say, most of them are still within the contracted rate area with a few of them dropping below. Let's dive into the Cedar Rapids market. This market here is a smaller market with volumes at 11.76%. So it's one of the smaller markets, but we actually see dry van tender rejection rates at 18.69%. So this is a very elevated tender rejection rate for dry vans. It's one of those smaller markets, and it's a very rare sight to see these over the 15%. So I wanted to bring this up and show you here. If you have an opportunity to head out to the Cedar Rapids market, this is a good market that you could send your truck to, but don't wait till your truck gets there to try to start booking its outbound load. You need to start booking your outbound load from the Cedar Rapids market as soon as you book your inbound load to assure that you're going to be able to get a load because volumes are so low. Jumping into our next market here, I've got Pittsburgh, PA. This market again has a tender rejection rate of 13.18% and volumes are at 53.92. So this volume is a lot larger, probably 3 times the size of Cedar Rapids, but we have tender rejection rates that are well over 10%. So this is another good market you can run your truck into. Look early, I believe their tender lead times around 2.5 days again, but rates are above contracted rates, so this is a good market for you to send your truck to. Again, I appreciate y'all tuning in today, but before we end this right now, I want to talk about a few areas where we are having some issues with weather, and that would be along the Midwest in areas above I-70, in Ohio, Chicago, Indianapolis. Those areas are getting a light snow right now, so keep an eye on the weather in those areas. And across the Northeast, we're seeing some rain and some ice. So before you head into those areas, be sure and check the weather, make sure your receivers are open, and make sure your pickups are not delayed either. Thank you.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Welcome to your Rail and Intermodal update. I'm here with Mike Baudendistel. Mr. B, what do you have for us?
So the other day we talked about Canadian National and just Canadian railroads in general having to slow down hazardous, trains covering hazardous materials, and that may impact, their network for other materials as well. The last couple of days, there's been yet another issue in Canada which is not helping. Those are protesters that are blocking the main line, Canadian National's main line, in 2 locations, one in central Canada and one in northwest Canada in British Columbia between Prince Rupert and Prince George. So this is what I have on the chart here. These are 40-foot loaded container volumes outbound from Prince George. So you can't go from Prince Rupert to the U.S. consumption centers, which is where the freight is destined, without going through Prince George. And you see what's happened here in the last data point. And this is the fastest growing port in North America is the port of Prince Rupert. So we're used to seeing positive volumes there. It's not constrained by having a lot of population in that area. So there's been a lot of just capacity expansion projects. So we're used to seeing this small port growing very quickly. And what we're seeing here is volume come down very significantly. Now some of that is from the Chinese New Year, slowing of that. I mean that's primarily goods that's coming from China. That's consumer freight that's goes all the way to say Chicago or Memphis. But also think it's being exacerbated here by protesters that are blocking the main line. CN basically said that Prince Rupert is basically shut down at this moment, and they're having issues elsewhere as well. So CN had a big press release that they put out, basically saying that this is disrupting supply chains, and I thought it seemed like posturing to get the government to intervene and force them off of those networks, which is illegal.
Right, and so this isn't the first time we've seen a protest like this, right?
No, I mean, it happens from time to time in Canada, and they all seem to be over kind of the same thing, the pipelines or First Nation issues over those lands. I would say the issue that it's over doesn't really matter. It's track and land that's owned by the railways, so they're illegal, and I think at some point they'll be forced off, hopefully sooner rather than later.
Right, and Mike, you give us rail and intermodal updates, but the other area of expertise, equipment, right?
Equipment, exactly. So I have experience covering the equipment companies, and yesterday had a report from Wabash National came out. This is the biggest trailer manufacturer in North America. They have about a 20% market share. Stock was up about 4% yesterday. I thought they were executing pretty well. They had some issues in prior quarters with not recovering some of the input costs, which not fully all the input costs are hedged, but they're doing a better job of recovering those costs, passing those costs on to consumers. But here in Sonar, we have orders for dry vans. In blue, we have dry vans. In green, we have reefer. In purple, we have flatbed. So you sort of see, obviously, the order of magnitude there. But you see the last spike at the right side of the chart. That was this last fall's order season. It was not as big as spikes the previous 2, 3, even 4 years, and that's really because the production of equipment has been at an elevated level for the past several years. So the manufacturers are expecting production for trailers to be down about 25% in 2020. That's still better than tractors and Class 8 trucks, which those are going to be down about 30%, maybe 35% plus. So a little bit of a damper dip there. But one of the interesting points that came out of Wabash is they said that pricing for the trailers is still pretty rational, that there's not, it's a competitive marketplace, but the manufacturers aren't cutting prices dramatically in order to preserve in order to sort of gain more market share. So it's sort of a mixed news there for a shipper or carrier that may be in the market purchasing that equipment.
Right. And you mentioned these significant spikes, and definitely not as significant in this latest round, mostly because there's been so much previously, right? Yeah,
so the average age of the equipment has certainly come down. I mean, you could make the argument that trailers are a little bit of a secular growth story because there's more drop and hook. You want to drop and hook in order to keep the scarce resource, which is the driver, busy, and the expensive resource, which is the tractor, busy. But at the same time, there's a limit to that, and trailers really didn't have the same fall off in basically 4 out of the last 6 years for tractors have been strong. For trailers, it's really been 6 out of the last 6 years. It didn't have that drop off in the middle years that you had with tractors. So trailers have even been more consistently producing above replacement levels for an extended period of time.
Got you, Mike. Thanks so much. And that's going to do for this edition of FreightWaves Now. Thank you so much for tuning in. Our media team is always working around the clock, so check us out on all your favorite streaming platforms with our FreightWaves TV app, on Apple TV, and on the Android marketplace. Thank you so much for tuning in, and we'll see you on the next episode.
Is the trade war back on?
Trade war.
Trade war, full-blown trade war.
15% tariffs on $112 billion worth of goods.
Hours earlier, China announced tariffs of 5% and 10% on U.S. products.